Okay, it's Tuesday, January 2026.
And we are officially in the thick of it. The future is here.
It really does feel that way. We're
Yeah.
settling into the mid-20s.
Yeah.
And if you thought the pace of change was going to, tap the brakes just because we flipped a digit on the calendar, well, I have some bad news for you.
Or maybe some very good news.
Yeah, I guess it depends entirely on how you're positioned, right?
It always does.
That is the truth. We have a massive stack of research on the desk today. And I mean, literally, it's a thump on the table kind of report. We are about to do a deep dive into the Morgan Stanley 2026 Thematic Research Report. And the energy coming off these pages, it's intense.
It is, and we need to be clear about what this is. This isn't just a list of stock picks or, some morning newsletter. This is a structural roadmap.
A roadmap, I like that.
The team at Morgan Stanley has essentially tried to decode the 4 massive structural shifts that are reshaping the entire investment landscape this year. We're talking about AI and tech diffusion, the future of energy, what they're calling the multipolar world, and of course, societal shifts.
And before we get into the heavy stuff, because we are absolutely going to talk about geopolitics, energy shortages, and yes, robots, we have to establish the mission of this deep dive.
Right.
Why are we doing this? Why does looking at themes actually matter? Why shouldn't you just buy the energy sector or the tech sector ETF and call it a day?
Well, because the data from last year proves that the old way of categorizing the world is breaking down. I mean, if we look back at 2025, it was a volatile year.
It was choppy.
It was very choppy. But if you were looking at the world through these thematic lenses rather than just traditional sectors, you didn't just survive, you thrived.
Okay, let's hit them with the alpha right out of the gate then, because the numbers, they speak louder than the narratives sometimes.
Okay, so in 2025, Morgan Stanley's thematic stock categories, and these are baskets of stocks organized around very specific ideas like AI enablers or energy security. These categories saw a price increase of 38% on average.
38%. Just let that sink in for a second.
Correct. For context, that outperformed the S&P 500 by 16%.
16%.
And it outperformed the MSCI World Index by a staggering 27%.
Wow. I mean, that is a massive spread. That's the difference between having a good year and having a change your lifestyle year.
It absolutely is. And if you drill down into the specifics, it gets even starker. There was one strategy they highlighted called powering AI.
Yeah.
Essentially, the thesis was to buy the companies providing the electricity and infrastructure for data centers, but to do it specifically during moments of market weakness.
So buying the dips on the picks and shovels.
Exactly. That single strategy yielded an additional 60% return over the 2023-2025 period. An extra 60%.
Okay, let's unpack that. That creates the context for why we are here today. We aren't just, philosophizing about the future. We are trying to find that next 60% wedge. And according to this report, the game board for 2026 is being defined by some very specific, and I'd say very aggressive, predictions.
That's right. And the biggest one, the one that really sets the table for everything else, is what they're calling the two worlds prediction.
All right, section 1. AI and tech diffusion,
Right.
this two worlds concept. Now, usually when people talk about two worlds, they mean like rich and poor or the digital and the physical, but that's not what this is about, is it?
No, not at all. This is about a fundamental divergence in the evolutionary path of artificial intelligence itself. We are so accustomed to thinking of AI as a single global race. Who's ahead?
Right, who has the best model this week?
Exactly. But this report suggests we are seeing a split between the United States and China that is becoming much more distinct here in 2026. It's like watching two different species evolve on two different islands.
That's a great analogy. So walk me through path A. This is the U.S. path.
So path A is what they're calling the frontier. The prediction here is very, very specific. In the first half of 2026, so we're talking the next 6 months, we're expecting a step change increase in the capabilities of American large language models.
A step change. So
Yeah.
we're not talking about a slightly better chatbot that makes fewer grammar mistakes. We're talking a fundamental jump in what the machine can actually do.
Precisely. This is being driven by what the researchers call scaling laws. Basically, the U.S. developers, the big names you all know, are throwing just a massive amount of compute at these models. The report estimates it's about 10x the compute that was used for the previous generation of models.
Just brute force then.
It's controlled brute force.
Yeah.
And the expectation is that this scaling is going to crack open completely new capabilities in reasoning and complex coding and multimodal tasks, things like understanding video and audio simultaneously in a deep way that we just haven't seen before. They are chasing the superbrain.
Okay, so the U.S. is going for the God model. What is Path B? What's China doing while all this is happening?
Path B is, well, it's pragmatic. It has to be. Due to the geopolitical restrictions on high-end chips and compute power, which we will definitely get into later, Chinese competitors aren't necessarily trying to match that raw frontier capability jump in the same time frame.
They can't.
For the most part, they can't just throw 10,000 top-tier GPUs at a problem as easily as a US hyperscaler can.
So they have to be smarter with their resources or just different?
They have to be different. They are aggressively focusing on cost reduction and practical application.
Making it cheaper and more usable, the utility play.
Precisely. They are building models that are good enough for industrial automation, for consumer apps, for everyday life. But they're doing it with much less compute intensity. So you have one world chasing godlike intelligence at a very high cost, and another world chasing ubiquitous, affordable utility.
And the report suggests that this divergence is going to cause some serious whiplash in the market.
It creates what they call the narrow funnel fear.
That sounds ominous.
Well, it's a valid concern. The market is going to oscillate, especially in the first half of 2026. On one hand, you have all this excitement about the step change in U.S. capabilities. Look, the AI can write a novel, or it just discovered a new drug.
Right. The demo is amazing.
The demo is mind-blowing, but on the other hand, investors get very nervous that the adoption is too narrow.
Of course, if you build a superbrain, but it costs a fortune to run, who is actually the customer? Who can afford it?
Exactly. The fear is that only a few ardent adopters, massive corporations, governments, are actually benefiting from this expensive, super smart AI that creates volatility. Investors will start saying, is this a bubble? Is there actually an ROI here for the whole economy?
But the report has a view on how this movie ends, at least for 2026.
They do. The prediction, and this is really the key takeaway for the year, is that by the second half of the year, that nonlinear increase in capabilities becomes undeniable. The utility becomes so high that the bullishness just takes over.
So we move from who can afford this to you can't afford not to have this.
That's the shift, because the capability gap is just too wide to ignore. Even if it's expensive, if it can do the work of 50 engineers or 100 analysts, you buy it. You have to.
Which means the volatility in the first half of the year is the buying opportunity.
That's the clear implication.
This leads us directly into the engine room of this whole thing then. If the U.S. strategy is more power, bigger brains, we have to talk about where that intelligence actually comes from. And the report introduces this concept that I absolutely love, the intelligence factory.
It's such a necessary shift in our mental models, isn't it? For the last decade, we've all talked about the cloud.
Right, the cloud.
And the cloud sounds fluffy. It sounds ethereal, infinite, almost free.
Yeah, it sounds like it's just floating up there taking care of us.
Right. But the intelligence factory grounds it in a physical reality. These data centers are industrial facilities. They are factories. They take in raw materials, electricity, water, silicon, and they manufacture a product. And that product is intelligence.
And like any factory, the economics matter. What are the margins on this intelligence product? Because that's what investors will care about.
Well, they're incredibly attractive. The model in the report suggests that for the leading LLM developers, the ones selling access to these big frontier models, the margins are hovering around 60%. 60.
60%. That is
like high.
That's not a factory margin. That's a luxury goods or a pure software margin.
It's software margins on an industrial product. And here's where it gets really, really interesting for the long term. The cost of production is plummeting.
This is the deflationary tech angle we always talk about.
It is, but on steroids. The report projects that as we shift from the current generation of GPU chips, specifically the Blackwell architecture, to the next generation, the Rubin GPUs, the price of a token, which is a basic unit of intelligence, could fall by more than 70%.
Wow, a 70% drop in the cost of goods sold. In any other industry, if your raw material cost dropped 70%, the price of the final product would just crash.
It would.
But wait, if the cost is dropping that fast, why are we constantly hearing about shortages and constraints? It feels contradictory.
And that is the crux of prediction, #2. Demand is exceeding supply. Massively. Even with those huge efficiency gains on the chip level, the appetite for intelligence is just growing exponentially.
There's a quote in the source material from a Google executive that, it just stopped me in my tracks.
I know the one you're talking about. They stated that they need to double their compute capacity every 6 months.
Every 6 months.
Just think about the math on that for a second. If you double something every 6 months, in 4 to 5 years, you have increased your capacity by more than 1,000 times.
1000x. That's not gross. That's a biological explosion. It's a phase change.
And we are seeing it in the usage data right now. They cited open router data, which showed that token demand, the actual use of these models, increased by over 2,200% from November 2024 to November 2025.
2,200%. In a single year.
So even if your chips get 50% or 70% more efficient, if your demand goes up by 2,000%, you have a massive problem. The report calls it a systematic shortage of compute power in 2026.
And it's not just more people asking for poems, is it? It's the kind of work the AI is being asked to do.
Correct. That's the other demand driver. We aren't just asking it to write a haiku anymore. We're asking for high-resolution video generation. We're asking for deep research agents that might run for hours to solve a complex chemistry problem. We're moving towards robotics, which is incredibly compute-heavy. These tasks just consume tokens at an incredible rate.
So we have a factory that basically prints money. But we can't build the factories fast enough or find enough power for them. The demand is effectively infinite, but the supply is physically constrained. And that brings us to the biggest bottleneck of all, the one thing you can't just code into existence.
Energy.
Section 3, the future of energy, or as I like to call it, the reality check.
It really is the physical bottleneck, isn't it? The rubber meets the road. For decades, electricity demand in the U.S. was flat. We got more and more efficient with LED lights, better appliances, smarter industrial processes. That whole trend has now reversed violently.
The report says U.S. energy consumption is set to rise 10% over the next decade, reversing decades of decline.
Which is a massive, massive move for a mature grid like the one in the U.S. And when you look specifically at data center developers, they are facing a 10% to 20% power shortfall through 2028.
So you're a trillion-dollar tech company, you're desperate to build your next intelligence factory, and the local utility company is basically saying, sorry, we can't help you. Come back in 5 years when the new transmission lines are built.
That's exactly the scenario. And this leads directly to prediction #6, the convergence of AI and energy. The tech companies aren't waiting around for 5 years. They are effectively becoming energy companies.
They're taking matters into their own hands.
They have to. They are buying infrastructure, signing long-term power purchase agreements, anything to control their own destiny.
We saw a huge glimpse of this back in December 2025, that Google deal.
The Google and Hut 8 deal, that was a real watershed moment. On the surface, Google provided a lease guarantee for a data center. Simple enough. But when the analysts at Morgan Stanley stripped apart the deal and looked at the underlying numbers, the premium Google paid for that guaranteed access to power was just staggering.
It's something like 300%, right? I had to read that twice.
A roughly 300% premium over the market rate for that power. That is the price of time to power. They are willing to pay triple the going rate just to plug in now rather than in 3 years.
That is the very definition of a seller's market. If you have megawatts to sell, you can name your price.
And the report says this desperation is going to push these companies to go off-grid.
What does that mean exactly? Like generators in the parking lot?
On a much larger scale, they have to bypass the grid because it's too slow. So you can expect to see AI companies buying things like solid oxide fuel cells, massive natural gas turbines, and even repurposing old Bitcoin mining sites.
That's fascinating. Why Bitcoin sites specifically?
Because the hardest, most time-consuming part of building a giant data center is getting the permit to pull 500 megawatts from the wall.
The interconnection queue.
Exactly. The regulatory queue can take years, but a large-scale Bitcoin mine, it already has that connection. It's already permitted. So you just kick out the mining rigs, you put in the AI server racks, and you save yourself 3 to 5 years of regulatory hell. They're bypassing the traditional utility queue entirely.
But this isn't happening in a vacuum. You can't just drop a massive gas turbine in a suburb without people noticing.
And that is the friction point. That's prediction #5, which they call the politics of energy. The public backlash is real and it's growing. We're seeing communities across the country reject data center proposals because they're loud, they use a lot of water, and crucially, people are starting to blame them for rising power bills.
It's the classic IMBY not in my backyard problem, but on a gigawatt scale.
It is, and it creates this fascinating conflict at the policy level. You have governments pushing for green goals, decarbonization, renewables, but at the same time, they are pushing for AI goals, national security, economic dominance.
And those two goals are now colliding head-on.
They are. The report suggests that policy is going to have to shift. And it will likely shift towards securing the lowest cost of energy, regardless of the carbon footprint, simply to keep the AI factories running.
So green might have to take a backseat to smart in 2026.
It's a very real possibility. When you frame it as a matter of national security, the strategic imperative for AI is just too high. You cannot afford to lose the AI race because you were waiting for a wind farm permit.
That is a stark reality.
Yeah.
And speaking of strategic imperatives and national security, let's zoom out. All of this, the chips, the energy, the factories, it's all playing out on a global stage that is getting more fractured by the day.
Which brings us to Section 4, the multipolar world.
The report makes a point to highlight that the new Trump administration is taking a very robust agenda into 2026.
It's aggressive. There's no other word for it. The goal is crystal clear. Eliminate dependency on China for critical minerals. We're talking about rare earths for magnets, enriched uranium for next-gen power, all the building blocks of high-tech hardware.
And this isn't just about trade tariffs or economics. This is explicitly tied to defense.
Absolutely.
Yeah.
Defense spending is pivoting hard. It's moving away from some of the traditional tanks and ships and pouring money into what the Pentagon calls emerging areas. We're talking drones, counter-drone systems, 3D printing for battlefield repairs, space assets, and electronic warfare. The source material notes a massive increase in funding for these very specific sectors.
Now, there's a new term introduced in this section that I think is just brilliant. We all know GDP, gross domestic product, but the report introduces a new concept, GDI.
Gross domestic intelligence.
I love this. It just clicks. What does it mean?
It's a proposal for a new metric for national power. It argues that in the 21st century, it's not just about how many cars or bushels of wheat your country produces. It's about how much intelligence your nation can generate. How many tokens can you process? How capable are your foundational models? That becomes the new measure of strength.
And in this new game of GDI, the U.S. and China are holding very, very different cards.
They are. The U.S. has the clear compute advantage. The report projects that the top 5 U.S. AI developers will command over 25,000 exaflops of compute power.
25,000.
And China, Huawei, their national champion, is projected to be selling less than 1,000 exaflops into the market. So the compute gap is massive. It's more than 25 to 1. The U.S. dominates the brain.
But there's always a but.
But China holds tremendous leverage in the physical supply chain. Gallium for semiconductors, graphite for batteries, rare earths for, well, everything high-tech. China absolutely dominates the processing of these critical minerals.
So it's a standoff. I have the brains, the AI models, but you have the body, the minerals needed to build the hardware.
And that leads directly to prediction #4. Expect intensifying trade negotiations where these assets are literally traded. We'll give you limited access to our AI tech in exchange for guaranteed access to your minerals. It's becoming a high-stakes barter system.
And this bleeds directly into manufacturing too, right? Prediction #7 talks about a manufacturing split.
Yeah, this connects right back to the tech diffusion theme. For 40 years, the logic was simple. The U.S. outsourced manufacturing because the labor was cheaper abroad. But if you have robots and AI that can run a factory 24/7 with minimal human oversight, the cost of labor matters a lot less.
Right. If a robot is doing the welding, it costs pretty much the same in Detroit as it does in Shenzhen.
Exactly. So the U.S. experiences what the report calls a reshoring renaissance. Manufacturing actually comes home because the tech diffusion reduces that old arbitrage of cheap labor. Meanwhile, China doubles down on its own indigenous supply chains, using its state-controlled banking system essentially as a massive venture capital fund to build out its own factories for the rest of the world. The global economy really does split into 2 distinct loops.
Speaking of distinct loops, the report throws a spotlight on a region that, I have to be honest, often gets overlooked in these big tech conversations. Latin America.
Yes, Section 5 covers the LatAm bull case. I found this part fascinating.
Prediction #8. After all this talk of the U.S. and China, why is Latin America suddenly the place to be in 2026?
It's what they are calling the trifecta. You have 3 major forces all aligning at once. Positive policy shifts in key countries, the change in geopolitics we just discussed, and the peak of the interest rate cycle.
But the key shift here isn't just political, it's economic. It's structural.
It is. Historically, Latin American economies have been largely consumption-driven. They grow when people buy more things. The big shift now is toward an investment-driven economy.
Meaning they are building things, real things.
They're building infrastructure, energy projects, modernizing industry,
Right.
and their domestic capital markets are just exploding. The report projects that the pool of domestic capital in the region could grow from about $2.5 trillion today to $6 trillion by 2035.
That is a staggering amount of growth. Which countries specifically should you be watching?
The report calls out Argentina, Chile, and Mexico as the key ones to watch. They are all, to varying degrees, shifting away from populism and implementing more stable policies designed to attract exactly this kind of long-term investment. And crucially, as the multipolar world creates friction between the U.S. and China, Latin America becomes that friendly shore, that reliable partner for investment and supply chains.
So if you're looking for that emerging market growth story, you should be looking south.
Precisely. And AI is poised to be an accelerant. If you can deploy AI to make your logistics, your power grids, your ports more efficient, you supercharge that entire investment cycle.
Okay, we've covered a lot. We've talked about the robots, the factories, the energy grid, the geopolitics, but we have to talk about us, the people, the humans in this equation.
Societal shifts. Section 6.
This is the elephant in the room, isn't it? Prediction #9. AI and jobs. Is 2026 the year the robots finally take over?
Well, let's look at the data first, not the headlines. Morgan Stanley surveyed a large number of companies in high automation industries. The result was a 4% net job loss globally over the last 12 months.
4% net loss. Okay, so that's not a full-blown apocalypse, but it's absolutely not nothing.
It's significant, and the breakdown is really interesting. 11% of existing jobs were actively eliminated, and another 12% were not backfilled when someone left, so that's natural attrition. But all of that was partially offset by 18% new hires for new types of roles.
So the churn is incredibly high. Old jobs are going away, new jobs are being created, but at the end of the day, there are slightly fewer of them.
That's the picture right now. And this is going to trigger a major policy response. The report predicts we will see government intervention really ramping up in 2026. Things like reskilling initiatives for sure, but in places like Europe, we might see outright job protection laws being passed.
Trying to legislate the robots away.
Or at least slow them down. But the economic force here might just be too strong to stop. Which brings us to the final prediction. Prediction #10, which the authors themselves admit is their most speculative, but I think maybe the most profound.
The deflationary force.
Yeah. We've spent the last few years completely terrified of inflation, but transformative AI at its core is an inherently deflationary force.
Elon Musk had that great quote about this.
He did. He said that applying 10x the compute power essentially doubles intelligence. And if you can double intelligence that easily and keep doing it over and over,
then intelligence becomes cheap. It becomes abundant.
Intelligence becomes a commodity. And if intelligence, which is what we pay lawyers, accountants, coders, and consultants for, becomes abundant and cheap, then the cost of all services has to crash.
So the prediction is that in the second half of 2026, we could start seeing the first real signs of price declines in the services sector, actual deflation.
It's a real possibility. There's an economist cited in the report, Dr. Anton Korenek, who outlines this theory. He says that labor loses its special status as an economic bottleneck. Historically, if you wanted to build more cars or write more code, you just needed more people. And people are scarce.
Right.
But reproducible factors like compute power and robots can be accumulated almost without bounds.
You could just print more digital workers?
Exactly. So the cost of anything that can be done by AI trends towards zero. But, and here's the incredible twist, this leads to rising values for all the assets that cannot be replicated by AI.
The irreproducible assets.
Land, raw materials, energy, human connection, and creativity.
That is a completely mind-bending concept.
Yeah.
We're heading into a world where smart is cheap and real is expensive.
That is the potential future this report is painting. The two worlds theme applies here too. There's the world of the digital, which is moving at light speed and getting cheaper every single day. And then there's the world of the physical, which is messy, it's scarce, and it's getting more valuable because it's the only thing that AI can't just generate out of thin air.
So after all that, what does this all mean for you, the listener? We've covered a huge amount of ground here.
If we synthesize this whole report, I think the key takeaway is that we are living in a world of widening gaps. The capability gap between US and China AI is widening. The gap between energy demand and energy supply is widening. And the gap between those who use AI to leverage their productivity and those who don't is about to become a chasm.
So it seems like the two worlds theme isn't just about geography anymore.
No, not at all. It's about the AI economy moving at a completely different velocity than the traditional economy. If you are stuck in that traditional economy, 2026 might feel slow, maybe even stagnant. But if you are plugged into the AI economy, whether it's through your portfolio, your career, or your business, it's going to feel like you're strapped to a rocket.
And that leads us to a final provocative thought for everyone listening.
We talked about gross domestic intelligence becoming the new measure of wealth for nations, but let's bring that down to the individual level. If intelligence, things like analysis, writing, coding, logic, if that becomes cheap and abundant, basically free, what happens to the value of human intelligence that isn't connected to an AI?
If you aren't a cyborg, are you obsolete?
Or does the value shift entirely to things that have nothing to do with traditional intelligence? Things like empathy, taste, curation, physical craft. Are we heading toward a world where the only truly scarce resource is reality itself?
That is definitely something to chew on. Are you investing in the simulation, or are you investing in the reality that powers it?
I think the answer has to be a little bit of both.
Definitely both. So check your portfolios, check your intelligence factory settings, and maybe go buy a little bit of land while you're at it.
Couldn't hurt.
This has been the deep dive into the Morgan Stanley 2026 Thematic Outlook. Thanks for listening, and we'll catch you in the future.